Partners. I'm the Chief Operating Officer there, and my role is really overseeing all of the operations. The company is an investment management company. I understand a lot of you are interested in that field. We basically, and I'll just kind of like water it down on what we do, we raise institutional capital. So we go out, and it's a big part of my job is going out to pension funds, foundations, high net worth individuals, a lot of insurance companies, fund of funds, any of these really large groups of capital. And we go and try to raise the capital based on the strategy that we have. The strategy that we have is to go and invest that capital into commercial real estate. And there's a lot of different ways you can invest in commercial real estate. We invest only in industrial, so multi-tenant industrial. If you think about it, they're like these little business parks. They're basically 2/3 warehouse and 1/3 office. There's some type of manufacturing in the back, and they're just little kind of community business parks. And we invest in those, and we usually buy them that there's something kind of wrong with them. They're distressed at some level. And we put about 10% of that purchase price back into the property to do things that make it more attractive for a future tenant and a future business. So those things are very simple, very basic. We update painting. We do a lot of like big, bold, bright colors because everyone else is kind of these concrete tilt-ups that are just kind of beige and boring. We focus a lot on signage, like really interesting signage, because it's kind of makes it look a little more creative office and cool. And then we do updates to the interior, which are, you know, tenant improvements, carpet, things like that. But the landscape outside, the parking, we redo parking lots, which are usually pretty old when we're buying an asset. So we use that 10% of capital to make those property level improvements. And then with that, and that usually takes us about 6 to 9 months to do all of those property level improvements. With that, we then say, okay, we're going to take over the property management and the asset management. And our whole goal is to focus on who are the tenants that are in there. Are they credit worthy? Can they pay their rent in like a time like right now, right? Can they, you know, how is their credit score? Do they have a personal guarantee here? There are a lot of small businesses. And they're really in a lot of different industries. That's one of the things we kind of look at for our product type. We feel like it's a good thing because, you know, we have in any given asset 20 to 200 different tenants. So it's not like if one industry or one tenant goes bankrupt or their industry crashes that we're going to be in a world of hurt, right? We don't have any one industry in any asset that is more than 13%. So we're pretty diverse where you've got a lot of different, you know, that's always kind of been our downside protection. And right now, unfortunately, I said this earlier, but it's, coronavirus is industry agnostic. So it's every industry is kind of getting impacted. But we make those improvements over the first 6 to 9 months. We focus on getting new tenants in. Usually we're buying a property where it has lower occupancy and someone just hasn't paid attention to it. And a lot of these properties, the ownership is really where we create value. The previous owner, a lot of times, is someone who is a high net worth and they wanted to invest their money in something other than, they bought a second house maybe and they flipped it and they thought, okay, what can I do to invest some of my money? I'd like to invest in real estate. And they look at multifamily usually, and they also look at these industrial business parks. So they stay in the family for quite a while. And so looking at the ownership is where we find a lot of opportunity to create value, because usually if it's been in the family for a while, the asset's been cash flowing, they usually don't put a lot of money back into the asset. They don't want to do that, right? Especially when it gets passed down to the next generation. So, you know, daddy gives it to their kid and their kid's living off the cash flow, and now the property's looking a little dilapidated. You think they're going to put $1 million in parking? No thanks. Like they're just doing the basic. So what we end up saying is we're going to do that, right? We're going to make that investment. So looking at the ownership structure of the previous asset's important. And then we make those improvements. We get occupancy up. Usually when we're buying an asset, one of the things we look at is the occupancy is typically a lot lower than the rest of the asset class and the competition set. So usually when we're buying, we're seeing occupancies of 70 or 80%. We know that gives us a real heads up on, okay, we can get this thing to 95%, maybe 100. I have a philosophy on if it's 100%, you don't have rents high enough. But if you have 100% occupancy, you might be a little light on your rents. So, but roughly 95%, I think, is a really good target on occupancy. So we try to say, okay, we're going to take this asset from 70% to 95. Well, automatically you've created value. You've got a rent roll that the next buyer is going to underwrite. And then the next thing we focus on is the existing tenants. So my tenant base is pretty short-term type tenants. They're 1 to 3 year leases. So we have about 1/3 of our tenants that are rolling every year. We get a chance to say, okay, we've made some improvements. These assets were performing and your rent base was, whatever it was, 60 cents a square foot. We're going to bring it up to 80 cents a square foot. Now, for the size of the tenant, it's probably pretty insignificant. They might have to pay a couple hundred, maybe $200 more a month in rent. It's not going to kill them, but it's what market is performing at. And that's why we bought the asset. We know if we made the improvements, they would pay market rent. And maybe they don't, but another tenant coming in would. So we really get to make up and create that value in driving the occupancy, because we're buying it when it's undervalued in occupancy, and then actually increasing rents to what the market is. That's how we perform all of our underwriting. So that's where we create the value. That's how we underwrite the asset. We only hold assets for roughly 3 to 4 years max. So we've got a lot of work to do to create that value. And usually when we're selling on a little bit of the come, because we've put the dollars into the capital improvements, but we've probably only turned about 2/3 of the rent roll. The other tenants still haven't renewed yet. So you're kind of selling it on, okay, but there's value still to be created, which most investors who are buying want to hear, that there's still value to be had. It's not maxed out. You don't have everyone at market. And so that's kind of our whole business model. And we put that in a fund format. And I'll talk a little bit about that if funds at all are interesting to you, because you can do deals like this one-off at a time. It's a little more complicated the way that we're doing it because it's in a fund format. So our business is raise the capital, deploy the capital by investing in different properties. We only do industrial. There's a lot of other product types out there that you can invest in. People do, parking lots. I mean, you can pick any type of real estate, but we specialize in light industrial, which I think is a really good asset class if you're looking to make any investments. So, and then we do the asset management and the property management and leasing. And basically that's kind of our entire business model. My role at the company is I oversee all of the operations. So that includes kind of the back of the house, things like HR, IT, marketing, investor relations, as well as how we operate our assets, property management and asset management. So really kind of truly how we run the organization. So it's an interesting job because I have so many different things that I get to work on. I'm not just in one thing. Like we have a head of acquisitions. He just acquires assets, which is really cool. And acquisitions is where it's at if you want to be in real estate. So that's a really fun job. But it's still limited. I get to talk to. I love my job because I get to talk to the investors. I get to understand what other things are they investing in, because they're not just looking at me as a fund manager. They're looking at gas and oil, and they're looking at all the different asset classes, natural resources, private equity, and they look and try to say, you, BKM, Barb, how are you going to give me a return comparable to these other asset classes? And they usually come up and say, there's a whole committee that comes up and they have asset allocators and say, okay, I have a whole pie. My pie makes 100%, and out of that, I'm going to say 10% goes to real estate. So that's my pie. That's what I'm going after. There's a lot of great databases and resources that will tell me every year all of these public institutions have to report on where their money is going to be invested. So if I am a public pension fund, I have to tell my recipients, where am I putting their money to make sure that the money is going to be there for them, for the system to pay out. And I go and look at all these, and it gets culled into these databases, and I go look and say, who's allocating and where? And I find the people who have a real estate allocation, and then I find out, do they have industrial mandates? Some of them have mandates like, hey, we've got too much office property or too much retail, we want industrial. And I will go and find out who has an industrial mandate or who's light on industrial. And those are the people I start calling to talk about, what are you looking for in your portfolio? So, all of these groups have a portfolio of their investments. It's by asset class, but it's also by risk. So the type of real estate that we focus on is what's called value add. And, there's something called core or core plus, and then there's value add and opportunistic. Those are generally the different categories that you have in real estate to invest in. And so what does that mean? It just means there's a different return profile and a different risk profile. So your core assets perform more like a bond. They're very low return level, which is not exciting to me, but it's really exciting for a lot of pension funds because they feel like, hey, that's low risk. I like that. So that's more of like a 3 to 5% return. Like, I find no interest in that. I want to kind of get out there and see how we can make some money for these people. But a lot of pension funds want to balance that all out. So they have a bucket for core. Then they have a bucket for core plus, which is kind of this tweener stage. It's, higher than a 5% return, and it might need a little work, but it's longer term. You'll hold on to those assets for a long time because they'll just, steady cash flow. Then there's what we do, value add. You can do it in any product type, which is a little higher level return. It's because the properties need something. They usually need a little love. They need some investment. So it's a risk, right, to put that money in. But with the risk is usually a higher reward. So our target return is a 15% net return on the asset level. And I mean, every asset we've done a full turn on, we've really exceeded that. And then opportunistic is just, you're going to be high risk, high reward, or maybe no reward. So, that's taking on something like I'm going to buy an office building at 50% occupied, like yikes, but maybe you turn that thing around. So, those investors are not my pension funds. Pension funds are pretty risk adverse. So most of the groups I work with, more institutional in nature, we're value add is probably as high as they're going to go on that chain of risk, because it's not crazy, but it does give them nice returns. And our 15s blended with these 3% that they're doing with some other investors all kind of net out that they're winning, right? They're going to do a 7 to 8 overall or something. So anyway, we're focused in the value add spectrum. And I can talk more about what we specifically, I guess, Philip, you tell me, do you want to talk more about the real estate that we perform in, or is it more interesting to talk about my role in the company and how the company operates?
We can actually ask like members and everybody else here, I don't know. Yeah, option 1 or option 2. Would you guys rather hear about her role or the real estate added part? I guess just kind of, you guys can either say it or type it out. And I think that'll be very interesting.
Yeah, I would definitely love to hear more about you, and then we can go to the real estate later.
Okay, sure, I'll do that. So I started my real estate career in 2001. I worked somewhere else in a different industry before that, but I moved to California and just trying to live the dream out here. And this is how my dad worked in real estate. He was a construction worker, so he wasn't a fund manager or anything like that. Very blue collar. I grew up in Philadelphia. Superintended on projects, job sites. I went to a lot of jobs with him, and I did really I loved real estate. I loved the high rise. I loved what he did. But I wanted to get into a different side of real estate, and I moved to California, and I felt like this is kind of the best place for it. I happened to submit my resume. Like, I think it was the first or second day we lived in California. I didn't know where I was going to work yet. My husband had gotten a job out here. So I'm like, I can cruise for a minute while I figure it out, or I'll work at Starbucks or like whatever. And I submitted my resume to the Irvine company, and they called me, and I didn't even know who they were. I just saw their sign on everything. And so if you're out here, you guys obviously know you've got the Bren Center at UCI, and you're basically at headquarter of Irvine Company campus right there. So I didn't really know. I just saw their name on every sign. I just was like, who are these people? I'm going to submit my resume. And I did, and they called me, and I started working in a marketing and leasing function for the retail group. It was a great job, and I loved it. And I also learned that that's not real estate. The rules don't apply for Irvine Company because they have no bank debt. They own the properties outright. The properties are all beautiful, Class A, and I mean, they've got this really amazing base built in where if you're a retail, you've got all these drivers feeding into this. Is not like, I don't know, Westchester, Pennsylvania, where I'm from, where it's just not that easy. You don't have the demographics built in. And so anyway, I worked there for 5 years, and I learned a ton while I was there. I had a great experience, learned a lot about retail, made a decision for myself that I was going to focus myself on different asset classes of real estate. I wanted to be kind of a generalist, and I loved my job there, but I had an opportunity, and this is life for all of us. I mean, I had a great gig at the Irvine Company. I learned a ton. I worked a lot with tenants and trying to get tenants into the retail spaces. And I learned a lot about leasing, negotiation, marketing, just real estate in general. But I really wanted to grow in my leadership and lead more people. And I really wanted to do a different asset class because I was just trying to get a little more well-rounded. So I went to a home developer, Centex. They became Pulte, and learned a ton about land development and home housing development. I oversaw marketing. I oversaw a lot of the operations for the company. And I learned a lot about how deals were underwritten, which I thought was really interesting. I was there for 5 years. And then I moved to an operations role at a company called Voight. Voight is a commercial brokerage. So they do all the like office, retail, and at Irvine Company, I was in the retail group, but I worked a lot with the office and multifamily groups. Voight was interesting because they had pretty much all product types, but a ton of industrial. So I got to work with the brokers, understand how the deals were done. I got to go on a lot of pitches to help get the deals done. But I oversaw all the operations at the company. Market research was a big component. Obviously, the brokerage side of the house and all the back house operations side, which I really enjoyed because it taught me a lot about what it takes to run a real estate operation. And it's so much more about the people than anything else. You have to have great processes, great procedures, and great people. And so I spent a ton of time in that role recruiting brokers. Why would they want to come work for that platform? What resources did we have to make their life easier or to make them more competitive? And that was all they cared about. So my role was really providing all the resources in order to win business. So I was there also for 5 years, and at that point, the owner, Bob Voight, I worked directly for the owner, had a partner who had this idea for the company, and it wasn't going to go there. He had this idea that we could also take on other capital and go buy additional real estate. But the owner, Bob Voight, said, no, I only want to do it with my capital. He was like a high net worth, but it was limited. Our opportunities were limited. And we had talked about this being the vision for Voight when I started there, and that we'd all get to participate in the deals, and there's some money there. And so that was exciting. Bob was, almost 80 at the time, and was like, I just don't want to do it. And so we ended up the partner said, hey, you want to come with me and go start this thing on the side, and let's go give it a shot. So I helped Bob unwind the company. The company still exists. He's retired though. He's not there. So I worked on a merger acquisition deal for him so that the company could transition, and made the decision that I was going to go into a startup environment, which I had never done. I had worked for bigger companies that definitely had more of a background. So that was a big risk, especially at that point in my career where I had good experience, I had a good background, I had, I don't want to say it was an easy job, but I was, well compensated and didn't need to take the risk, but I did it. And I will say it was totally worth it. Big risk, big reward. And it's been a lot of work building out the platform. There was like 5 of us in an executive suite when we started. We now have 100 employees 5 years later. And it's been really exciting to challenge myself. I'm like, hey, what could we do? How do we do this? We knew we all have this great love for real estate and creating value in the real estate, but how do we don't have the capital to go buy all of the real estate ourselves. So how do we get into the fund business? How do we go raise the capital, put it to work, and then create value for the investor, but also for ourselves, so that we get to participate in all of those transactions. So it was exciting. I got to spend a lot of time. I felt like a student in the beginning, writing, understanding the business. I didn't understand fund management at all. I went to a ton of conferences. I read a lot of books. I talked to a ton of people, and I think with that, I started to really get my arms around what this fund business is and why it's so unique and special. And I just felt like we can totally do this. We can conquer the world and we can go build this thing. And so we did. And so now today, the company is, we have $1.7 billion worth of assets under management. All industrial, all in that same product type. It's, I think, 52 different properties. It's, I don't know, over 10 million square feet of real estate. It's a healthy portfolio and it's performing really well. We have a fund, 2 funds and a separate account with CalPERS. So we've got some big brand name institutional investors that have backed us. So it's been really interesting to get here. My role, so when we started the company, it was building out the infrastructure. I mean, it was fun to learn this along the way, but we started having due diligence. Investors would talk to us. We got them to talk to us, but then they would ask questions like, hey, what's your disaster recovery program look like? Can you send me the policy? And I just I'll never forget Googling disaster recovery policy and thinking, I have so much work to do. I didn't have an IT guy, so it's, anyway, it was very humbling. So now I have a compliance department and, a fund accounting group and a really healthy tech department with business applications and data research people. It is amazing what the company has kind of evolved into. But at the time when we were trying to raise capital, the questions that they asked informed me what we needed to be and what they expected of us. They cared a lot about the policies and procedures and our ability to source real estate, which we had a really great story on because several of us were an uplift from VoIP. And so the main partner and several other people. And so we have great brokerage relationships. In fact, I spent, 5 years of my career recruiting brokers. So I got to know them very personally. And I knew what was important to them. So it helped us do deals. Those relationships, VoIP was actually in all the same markets that we were going to be in, we're now in. So we're basically Denver West is our territory. So we always look for assets in those markets. We like these, I don't want to call them tier 1, maybe tier 2 cities that are near ports or have some other business driver. That's a key component in where we look for the real estate. So the investors really informed me of what was important more than I understood. And so they would ask me for, what's your policy on this? Or how do you do this? And then I started realizing oh my gosh, we don't have a policy on that. I need to create one or have find a resource that'll help get me there. And then I realized someone needs to administer the process. And then as the money starts coming in for the investment, you realize I need to invest in a person that actually just does this. And so, the job that I had was kind of like, I would do everything to get the investors to come in, and all of the legal documents. I still spend like 90% of my day with legal, which I prefer not to. I think I have a JD, but I guess I don't. I just spend a lot of time with these guys. But so there's a document that you use for basically when you go out to capital raise, they're going to want to see. It's called a private placement memorandum, or a PPM. And, I spent a lot of time working on that. And this is why I feel like it's akin to being a student, because it was my thesis. It's our investment thesis, and it's a big document, probably 150 pages. And it's basically your investment thesis on why you think this product type will deliver these kind of returns. What is in you and your team's background that says you could do it. And so there's a whole thing, and it becomes this big legal document. And then the last 30 pages are all the legal crap, where it's just like all about how you trade assets, and the fact, are you or are you not a registered investment advisor, and what risk you're going to take, and what your tax implications are by country. And so I learned a lot just putting that together. Again, it was definitely like, it was being a student. It was like my senior project, I felt like, and that becomes this book that you use to go raise all of the capital. That's kind of your fact checker. Which is pretty cool. And it helped me, it really just helped me understand what was important to the investors. I think talking to investors always reminds me of what do they care about. And they have a lot of people that they report to, like the people that are the pension fund recipients, and they need to make sure that, we're being as transparent as possible and giving them all the information. So I spent a lot of time on investors at the office, just talking to them, providing them updates. So, once you get them to commit to your fund, which takes a really long time, I didn't know that either. I thought it was so charming. I'm just going to get them into the fund, and they'll write me a check for 40 million, no big deal. So that took a lot longer than I anticipated. Due diligence is, 9 to 12 months minimum. And like, normally that's just when they're actively talking to you. I have groups that I'm like, I'll get them on the next fund, but I've been talking to them for 5 years. I did not know that was coming. So I think as a first-time manager, your first fund is definitely the hardest. No one wants to take a risk on you. There are too many other options that they don't need to take a risk on a first-time fund who doesn't really have a track record, and it's too risky. So we had a couple guys that took a risk on us, and so thank goodness for that. So the way that we were able to kind of kickstart that, and I thought this was great, and it just shows the power of like a network. We were not getting traction with institutional investors in the beginning, even with our PPM and all of our great documents. We didn't have a huge infrastructure. There's literally like 8 of us when we were trying to go raise capital. So I don't know how we thought we were even going to execute on this. So what we did was we went and did a friends and family raise, and that allowed us to go buy 4 properties, and that are in the product type that we wanted. That was our investment. This made our investment thesis real, right? Other than that, it's just like you put together a nice little book, and it says all the things you want to do, but like, I don't know, can you do it? So then, and what do those properties really look like? Like, really, can you do it? Can you find the deals? Can you source them? Can you execute on them? So this money that we raised with our friends and family group allowed us to go buy and prove up the theory. And it worked out, because when we did that, the assets started performing really well. We made improvements on it. They started performing, and that got the interest of the investors. So when we went to raise capital, we said, look, we have these assets. They're already in there, and you can come in at cost, meaning like we won't back charge you for when we started owning these assets. When you come in, you come in. Even though there's fees that our friends and family kind of did some carry on, and we all put in money and did some heavy lifting on the fees there. We'll do that to get you in if you like these assets. This is kind of a sneak peek and a preview. If you're an existing fund manager, you can just go, well, look at my last fund. That's what I do. That's my track record. Like, we didn't have that. So seed assets allowed us to say, these are the type of assets we'll buy, these are the markets we'll buy in, and look at how they're performing. That's the only reason that people came into the fund, really, is that they felt like they had a good purview into that. Second fund was a lot easier, and it wasn't easy at all. Fundraising took, and I feel like I want to share this. If you're at like a colony, fundraising you can do in 6 to 9 months, no problem. You've got a brand name to build off of, really cool. We didn't. So Fund 2 took us 27 months to fundraise the $400 million. That was longer than I expected. I just kept thinking, please let me do another close and get this done. We had what's called a hard cap, meaning you can't go above it, but I really wanted to hit it. And from first close to final close of equity, you have 12 months. You've got a limited time period. And so I wanted to make sure, how do we maximize that and hit the cap? It's just a better marketing story if you hard cap a fund than if you're short of what you said you would put in, because then they're like, oh, they couldn't get the money. And that's just not a good feeling. And also the investors want to know that it's maximized. I had several investors. This is why it's like a tricky little math thing. I had several investors that said, all right, I'll put in 25 million, but I will never be more than 10% of your fund. So I'm like, I have to get at least 250 million in, or I don't get to draw down the full 25. And I had several investors say things like that to me. So I'm like, okay, this has got to happen. I'm taking down all of that money. I will not leave the committed capital on the table. So you had to get to this milestone, which gets a little tricky. But it's fun. I think it's like the capital raising side is something I really enjoyed. And it's something I probably won't do as much in the future. I think we're going to take that really seriously, and someone's going to make that their full-time job, right? That is someone's full-time job. It shouldn't be my part-time hobby. So we're going to take that a little bit more seriously and have someone really dedicate a lot of time and energy towards that. So I can focus more on running the company. Investors will always want to see me because I'm, an original member of the team and because of my role, but I'll have plenty of chances for that. So we interact with the investors really often. In this current time and crisis, I have talked to my investors, more than ever, because they want to know, how are the assets performing? We underwrote you knowing how you could perform in a traditional downturn like the 08-09 meltdown. But how are you going to perform right now? What are you doing to kind of position yourself in a way that you're going to be okay? And it's interesting because the group of investors that I work with, they have other asset classes that they're invested in. And I just say, well, we're not retail. And I'm so grateful for that. We could be in hotel or retail right now, and it's an immediate stop. Those tenants are not in business. Industrial, these are not consumer facing asset classes. So it's not like everything completely shut down. You can still manufacture products and goods. So we're in, I think people are using Amazon a lot more right now than ever. So I think our asset class is pretty well positioned. So I feel like I've got a decent story, but I can tell you it's a real panic with 1,700 tenants in our portfolio and how many are going to pay their rent this month. And I think for us, May is going to be our biggest month. We actually have 80% of our tenants that we're able to pay in the month of April. We usually get close to 100, so that's not great. We can still make the covenants on our bank loans. No one's giving commercial landlords, any grace. We still have to pay the mortgage. So when tenants decide not to pay, and there's some grace for them and there's programs for them, we're happy to educate them on some of those public assistance programs, but we don't get a break. We still owe the banks, and we have to make sure that we pay the bank loans or they're going to take the properties away. So that's definitely a little bit scary. I have a great team that's kind of boots on the ground executing on our strategy, and they're really focused on how do we maintain value. I personally believe this coronavirus thing is not going to last forever. But I do believe we've got business-wise, we've got a rough couple months ahead of us, but we will be back. All of the businesses are at some point coming back and reopening, unlike 08, 09, where it took a while to go down and it took a really long time. It took a decade for us to get back up to where we were in 08, 09, a decade. I don't think this is that like that at all. This is an immediate drop and we're going to come back. I think our lives will all change. I think we'll do things differently. I think we've learned students can now, work remotely. They're not just skipping class if they don't show, maybe they can Zoom in. We learned that, office workers can also work remotely. I think we'll change the way we use office space. So business owners maybe don't need as much office space in the future. There's a lot that I think we'll learn from it, but I know we're coming back. It's not a forever thing. This is not the 08, 09 crisis, but it is impactful right now. So, biggest duty we have right now is to make sure we share with our investors that, hey, we're paying attention and we're looking at the trends. We're tracking how many people are asking for rent relief, how many people are paying, what are we doing to help them? And just because you ask does not mean you get. So we're basically bucketing people because we can't afford to do that. And so it's interesting. I read a lot of articles about this, and I'm in a leadership group called Vistage, which is a really great program. If you've ever heard of YPO, it's kind of similar, but it's a bunch of CEOs of different companies, all different industries. You get together once a month, you share your stories, they give you advice on how they've solved a similar problem, or they ask questions that are like, kind of make you go, oh, why didn't I think of that? But great group of people. I have a guy in my Vistage group who basically said, oh my gosh, you wouldn't believe what my landlord is making me go through, in order to get a rent break this month. And so he shows me the document. I'm like, well, what'd you think was going to happen? You just ask and you get. I mean, you can't say yes to everyone. So I'm like, if you think that the paperwork is too much of a pain in the butt to fill out, sounds like you don't need rent relief. And that's just the reality of it. I mean, we have people that their business is doing okay, but they're scared. So they're asking, okay, well, we look at your financials. We go through every tenant's financials, their credit worthiness. If their business has really, truly not been impacted yet, we're not giving them rent relief yet. They can revisit that next month with us, but not right now. You are okay. Then there's the tenants that's like, hey, they had a big contract that was canceled. But they're a really good tenant. They always pay their rent on time, but they're really hurting. We will work with them. We will do something, and we're doing it case by case where it's like, okay, I am going to reduce your rent for the next 3 months by whatever it is, but whatever their need is, 50%, 75%, whatever that need is. And we're going to work with you. We're also going to extend your lease term for another 3 months beyond that. We need to be smart. How do we kind of make this up and make sure that they can make it up? Or we say, okay, we're going to let you skip the next 2 months on rent, but you have to, that's going to be kind of sectored out for like the remainder of your lease terms. Then we expect it to be incorporated, but that's a hit on us. So we don't do that for everyone. So we take it case by case. And then there's just the last group where it's like, hey, they never pay their rent on time. They're kind of like not credit worthy. Well, I don't even know why they're a tenant in our park. And probably not, it's probably not worth trying to keep them because they'll probably never make it up to us. So we're cautious about who we're kicking out right now. It's kind of heartless to do that. And frankly, we want the occupancy because we do believe we're coming out of this and that they're going to be paying again. But that's kind of how we're looking at the rent relief scenario and just how to get through this. So our teams right now are busier than ever because they're dealing with a crisis that we hadn't planned for. It's impacting so many different segments in industries and markets. Typically it's like, oh, Vegas might get hit because there was something that was, entertainment related. Well, no, this is all markets and all industries have some level of being impacted. For us, any of our tenants, and we have a very small percentage that are entertainment focused, but we have entertainment and like special like health and wellness, things like gyms. So we have some CrossFit gyms in our parks because they're using the industrial space for that. Those are impacted, but they weren't so impacted that they couldn't pay April because a lot of these studios are on like monthly membership. So like some of the groups already had, they paid for March already. They were not impacted in March. April, maybe they're starting to feel it, but we'll start to feel those by May for sure, where they just, most of our tenants have like at least 3 months in reserves on their space that they could pay rent for. I don't think they want to have to do that, but of course they usually have that in their reserves so that if there is some type of crisis like this, they can get through it. And I think one of the good things about the type of tenant we have is this is their livelihood. These are smaller businesses. And if they don't pay their rent, that means they're not eating dinner, because if they're not keeping the lights on for their business, they can't do it on the home front. So this is a big deal to not pay their rent. And I think that's definitely one of the downside protection components of the asset class that we're in. We look at it a lot like multifamily, where an apartment complex has a lot of different renters. So it doesn't kill you if 1 or 2 of them fall out, right? But so that's kind of how we look at it. What questions can I answer for this group?
I have a question. Do you guys ever work with like any medical facilities, and like how's that process? Because I know it's a little different because you have to, there's like more requirements on the property, right?
Yeah, so there's so many different segments. There's like cold food storage, there's medical office building, there's all these really unique niches that have a lot of special requirements. We really don't do that. The best I can say that we do is we've got a lot of tech type, like 3D printing that are printing a lot of medical devices and things like that. But no, and those have more insurance risk, and we're pretty basic on our product type. We know what we're good at, and we've just been staying in that lane. That might change in the future, but it's really easy when you know your tenant base and your spaces, and but there's so many, like, and even in industrial, like the cold storage is a whole different subsector that we could start working in because it's very similar to our space. But no, that's not our product type. But someone's probably killing it in that. So yeah. But they know what to look for, and we don't. Like when you're underwriting a deal, you need to know where like the bones are buried, and you need to know what could go wrong with the product type and what really is inefficient. And if you don't really specialize in that product type, a lot of things could happen where you don't underwrite for, I didn't expect to have to change HVAC units on 80 different units. And we have to think about that there's just so many things that could come up. And I think like if you're not specialized in the product type, those are the kind of things that could come up later and really, really alter your return for your investors or yourself. So you want to make sure you know the product type pretty well.
I have a question for the investor standpoint. So like, of course, like your first seed round funding was like a lot harder to get because there's like, you need like kind of a platform or like kind of like results in a way. And that's of course harder. I'm just wondering like if like, I guess say an investment doesn't go to plan, like if like some investment didn't actually pay off, like how that affects, like how would you like overcome those kind of those bad like results?
It's awful. So I actually have been really lucky because we don't have a lot of underperforming assets. Every quarter, next week I have two of my funds I have annual meetings for. Every quarter, me and the rest of my team have to get in front of our investors. Normally this would be in person, but we're doing it like this. And I have to report on the performance, the financial performance, the asset level performance, and I go asset by asset, and there's like 35 properties in a fund. And they want to know how is it performing and what issues do you have? They want to hear it. Transparency is everything. We have assets that we put on a watch list, and that's either their occupancy is really low or there's spaces that are challenged. Most of our product type has one single level, but there's some, industrial that has mezzanine up top, which is a really awkward space because no one wants to be on top of an industrial space. Like it's just weird. And, so if we have some open mezzanine space, like if someone wants to get out of it, or we're hard pressed to lease that up, it'll impact occupancy. If we know we have a really large space and no one in the market is looking for a big space, we will then say, okay, that tenant moves out, we're going to take it and we're going to re-demise it into 5 smaller spaces because that's what people are leasing right now. That costs money. We have to have thought of it and underwritten for it when we bought the asset. And we do, we look and say, okay, who's going to be falling out or up for renewal, and we don't want to keep them, and we think it's better to get a higher rent at a lower space. All right, we underwrite how much it'll cost, what the downtime will be. So you hope you underwrote those things and gave yourself enough time and gave yourself enough money, but that might not always be the case, or the market might not have performed for you. I think one of the biggest challenges on the fund side is you don't just hold the asset until it's the right time to sell. You have a finite period of time. So for us, we have 35 assets that we have an investment period for, where we go out and buy all the assets. And at the end of that investment period, we have the fund term, which is for us, it's 5 years. It could be any, but that's our defined period. And we're underwriting assets to sell within 3 to 4 years. And you have a lot of rules and regulations, how many assets can sell per year, or you're going to trigger some compliance issues. So some REIT compliance issues. So you might have an asset that's ready to sell. It's going to hit the best return right now, but you can't sell it. You already sold too many assets this year. Sorry. So that's a risk. So we have a position in our company called a portfolio manager, who actually balances all of those risks and says, okay, this would be the best time to sell. But you could get into a situation where you're going to have to take a risk on something and hold it longer, and the market could tank, or shift in a way that you're like, oh my God, if I just sold it last year, but I couldn't for these various reasons, or I didn't hold it long enough. We have to own the asset for 2 years before we can sell, or we have a tax implication. So there's a lot of different variables, but if your asset is underperforming in some way, disclosure is everything, and it's not going to sneak up and be a surprise. You're gonna know what you bought it for, and every quarter at the minimum, you're in front of your investors and you're going asset by asset and saying, here's the problems with this asset, and here's what I'm concerned about. Here's occupancy, and here's what I'm looking forward to, and here's the issues, and here's how we're going to address them. So they want to hear that you're on it. You see it coming and you're on it. But if something happens and it's bad news, you got to deliver it. So, and we had one asset where we had a tough time with, because we bought it and we knew we needed to get some of these buildings re-entitled. And in most instances, we buy business parks, which are these large buildings that all kind of group together, and each one of the buildings has 5 to 10 tenants in it. So normally you would go and you would do some type of re-entitlement by the building, and that would cover the 25 to 20 tenants in it. That particular city had some really weird regulation, and they said, sorry, you have to come back and do individual plans for each one of these, and we can only take so many at a time. So instead of us being able to do all this initial construction work, which we always do in the first 6 to 9 months, it took us like 1.5 years to get through all of these permits with the city. And with that, you lose time, you can never get it back. So the money we could have gotten on increased rents or increased occupancy, you cannot make up. So really great lesson for us to learn is that you gotta do what you say you're gonna do and what you underwrite, and time is everything. So if we killed 9 months on a deal that we're only underwriting a 3-year hold period, you cannot make that up. So that hit the return, and we still hit a return that we committed to, but it was, we weren't excited about it. We we say we're going to hit a 15, but we want to hit a 30, we're really disappointed in that one, but our investors are okay, because we're still blending all of these assets together at the fund level. We're still well above our net 15 target.
I actually have questions. So like when you say that you're gonna hold the type of asset for such a short period, like what kind of loan options do you take? Because they have like 30 years and they are like variables, like you can use it to just buy it and then sell
Yes, we do. So commercial loans are a little different. Like the max you would see usually is a 10-year. Unlike your mortgage, right? Your mortgage should be 30 to 50, I think nowadays on residential, but commercial is different.
Yeah.
However, our loans are typically 3 to 5 year. So a lot of our loans we're getting for 3 years with 2 1-year ARM extensions. So we can get it. So if we don't hit it in that time period, we can increase that. I mean, and we've had to do a lot of work with the banks to sell them on why we need a loan like this. And that's been a lot of work for us.
I see. Yeah, that makes sense because like you only you don't want to use all the values in the asset and sell it later.
Yes, we leverage usually at about 65% max. And that's something that investors want to know. And that's another component in terms of the risk profile. So some of the core or core plus is not only like higher occupied and just kind of like better class A type real estate. Also, the leverage is typically lower. It's something that they just feel a little bit more cushion if there's some type of down cycle in the market. It's not as risky. So, and what that does is you're more able to meet your loan covenants if there is coronavirus. So, yeah.
So like when you talk about like when you first go into like the startup and then you raise raise money to invest into 4 properties, like what is that period? Is this like a strong market, or can you elaborate?
That was a really good market. Great question. I think we were like real prime time to buy. We bought them in 2014. So we were itching to start buying again. So, 08, 09 were really rough. And it took till, I would say, you wouldn't want to buy until 2012. That was kind of how the market was. And like, it was probably mid to late 2012. We're like, we should start buying again. And that was exciting because we were seeing things come to market. They were still well below replacement costs. It was a good time. It was a good time to buy, and there's a lot of opportunities on the market, and people wanted to get out who were stuck with assets. So that was kind of when we started really coming to the idea that we need to do something with this. We need to go get money so we can go buy right now. And that's when we started creating the platform. So our first seed assets were in 2014, early 2014, and it was a really good time to buy. So yeah.
And like the platform is BKM, right?
Yeah.
I'm like curious like with COVID going on, like do you see like kind of an opportunity to buy like years down the line, kind of, or like is this like kind of like a different type? Because I don't think it's like the same as 08, 09, but I think there's like some stuff that's like
I mean, here's an example. I have a portfolio of assets that I'd like to sell. $100 million. I stopped it. I don't want to transact in this current environment because someone's going to be a bottom feeder and they're going to want a deal, and I'm not ready to give them a deal because I don't think we're there. So I'm holding. And I mean, I think there is opportunities to buy. I'm out of dry powder. I'm out of capital. I just fully invested the fund. And if I did have powder right now, I would be probably buying, because there's deals to be had, and anytime you're in this kind of uncertainty, there's deals to be had. So if we had capital, we would buy, but I won't sell right now. No thanks. So I have another call, but if you guys have any follow-up questions, you can always, Philip has my email. You can always shoot me an email. Yeah, so please do. It's been a pleasure just chatting with you guys.
Thank you, Barbara, for coming
thank you,
out.
Barbara. Thank you so much.
All right, thank you.
Thank you.
Again, if you have any questions, feel free to shoot me an email. Sorry to cut it short. I just have a legal call.
For sure. I was really busy.
Yeah.
Always super busy.
All right. Thank you guys.
So much. Thank you.
Thank you.
Stay safe.
Stay safe.
Thank you. You too, guys.
All right.